What's up, guys? Welcome to Stock Talk with Nico Criticos. Today, we're going to be doing some stock analysis on Palantir stock. Now, unfortunately, this is a stock that is down quite significantly over the last 2 years since it went public. And it's also unfortunate that this is a stock that I bought into. So today, we're going to take a look at the fundamentals of this company and find out if it's finally a good time to start buying. So this stock in October of 2020 went public at $10 a share. And soon after that, it went all the way up to $35 a share. And now we're down to $7. So pretty much anybody that bought this stock is down on their position. As you can see here, I unfortunately bought 185 shares at $18 a share. I'm down over 60% in $2,000. So not the most ideal situation here, but we're going to do the best we can with the situation. So I read through some articles about this company, and there were some interesting things that I learned. One of those things being that Palantir has quietly become a significant investor, investing well over $200 million in 8 different companies. Thereby, it is following the lead of companies like Tencent, Alphabet, and Shopify of establishing valuable investment portfolios. That is something that I did not know. That is something that's interesting and makes this company a little bit more attractive in some sense. Because trust me, as we get through the checklist today, there's plenty of stuff that makes this company look unattractive. And if we go down, we can see more about among the investments are robotics company, Sarcos, biotechnology companies, biopharmaceutical companies, and it says each one offers a chance for Palantir to get in on the ground floor of what could be the next IBM or Tesla. So that sounds all nice, right? And the next thing here was about Peter Thiel, who's a co-founder and chairman of the board, and he has a pretty good reputation for one reason being that he was one of the first outside investors in Facebook in 2004. So that's also another interesting piece. The next thing we're going to look at is their latest earnings presentation. And keep in mind, part of the reason this stock, there's lots of reasons this stock had such a giant run during this time. One was because it turned into like a popular meme stock in the retail crowd, largely in part to ARK Invest and Cathie Wood talking about it so much. And also because of its growth. And at this time, they were growing, I think they said, they were growing about 30% a year, near 30%. And they said they were going to be able to maintain that up until 2025, I want to say. Well, now today we're looking at their numbers and they're growing 22% year over year. And it's actually expected to go down next year to 20%. So that 30% growth number that was there 2 years ago has now dropped 10% to 20%. So quite a difference there. Anyways, revenue grew 22% to $478 million. And you can see here that their US revenue outgrew that, as well as their commercial revenue. The other main thing about this company is they've been around for a while, working with having government contracts and working with the military with cybersecurity things and a bunch of different types. So what Palantir does is they're a data analytics software company that uses artificial intelligence to help. Previously, it was only the government, but now their not the main business, but the business segment that's growing faster is the commercial segment. So they're using their software to help corporations and businesses save money on their business. So that is something to look out for here, is that commercial segment. As you see here, commercial revenue grew 53% year over year. That's the big catalyst for this company right now. And their government business surpassed $1 billion of revenue. Okay, that's great. Customer count increased 66%. That's huge. That's a big deal. And so we have things like that. They're working with some pretty significant companies, and these type of testimonials are very interesting. So we have this guy right here, the CTO of Tyson Foods, saying that the company saved over $200 million, right? And there's multiple people that say things like that. Multiple of these executives say something along those lines. Another interesting one was this one that said there are 15,000 souls that would have not have been able to be evacuated from Afghanistan unless we had that foundation. So they definitely have a bit of a moat and a interesting business proposition. So that is one good thing going for this company. But if we get started with the checklist, we're going to look at revenue and net income first. If we take a look at revenue, they've grown revenue from 190 million 4 years ago to 477 million in the latest quarter. So the growth is good, right? It might be slowing a little bit. Who knows if that's temporary or not, but the growth is there. Net income, that's where the big issue is. 2019, they lost $139 million, and they're still losing over 120 million in the latest quarter. So that's why revenue is good, net income not good. If we look at their valuation as far as price to earnings or price to sales, they are unprofitable. So the PE metric is not the best metric to use here. However, we can use the price to sales, even though price to sales is not as helpful as price to earnings. But the price to sales is up. The price to sales is an 8, and how I said the revenue growth is between 20 to 23%. It's actually slowing. It was 30% a year ago, and this year it's expected to be 23, and the next year 20. So it is slowing, and it's trading at a price to sales of 8, right? Well, this is a picture that I have. Let's see. Can I show you guys? Let's see here. I want to show you this picture right here. And here you can see this is a graph I made showing if whatever the price to sales number is, this is kind of what should correlate as far as revenue growth goes. And it's right in line. They're trading at around an 8 price to sales, and they're growing right around 20%, 20 to 23%. So this is right in line. I can't say it's super overvalued or super undervalued. So that will get that's fair. That will get a yes. That's a healthy price to sales. Innovation and their moat is pretty strong. I think having military government contracts is something that not many companies can say. And they are innovative. Their technology, their AI technology that they use in their software is definitely strong. Otherwise, why would the United States military be using it? So, and we see big corporations like Tyson Foods saving hundreds of millions of dollars. So that's hard to argue with there. That looks like a pretty strong moat and innovation. Number 5, the industry is growing in so many different aspects, whether it's cybersecurity is a huge one, artificial intelligence, data analytics, and there's lots of different ways you could say this industry is growing. Return on invested capital is negative, so that's going to get a no. Cash flow, this is an interesting one. I would not consider this healthy. If we come down to this graph of free cash flow, what we will find here is that it's not very good, and it hasn't gotten much better. And if we look at stock-based compensation, it makes it look a whole lot worse, because stock-based compensation for all these quarters here, they were doing 87, 20, 56, $32 million of free cash flow, and stock-based compensation is about double that, 184, 167, 149, 145. So not good. That is not a good sign there. If we get further into the cash flow statement, what we're going to find is that it could be better, because we look at operating cash flow. It was negative for multiple years. It's finally positive, but it's down significantly from where it was a year prior, and they invested last year more money than they brought in from operating cash flow. So, and they are sitting on a bunch of cash, but that's because they financed a bunch of cash. And you also have the stock-based compensation thing messing up this company. It's so many different aspects. It messes it up by diluting the shareholders. It messes it up by they're pretty much like they're not making money, so they're having to dilute their shareholders and issue more shares to raise money. And not only that, but the people they're hiring through the stock-based compensation, there's many factors contributing to the stock price going down from 30 something dollars to now $7. So that means that they're going to have to issue 5 times as many shares as what they were doing 2 years ago to offer the same amount of equity, the same amount of value. So it's just a really bad downward spiral when you look at things like that. And again, they're sitting on some cash, but that's not, that doesn't mean a whole lot. Number 8, diverse revenue streams. I put yes. They have the government sector and the corporation segment of their business, and they're a global business. I mean, they're also working with, I just think the fact that they're having the corporation segment and the government segment is such a strong moat. I would consider that diverse. Number 9, growing equity. Yes, indeed. If we look at equity here, we will find that equity has gone from negative $1.9 billion and then $2.3 billion in the most recent quarter. That will get a check. Is it over 15%? Yes, just by a very small amount, though. I think it's $2.2 billion is 15%, and they're at 2.3. So they barely made that, barely. Share count decrease? No, not even close. If we want to look at that graph, that goes back to what I was saying. Shares outstanding or can keep increasing, so that's not good. Healthy amount of debt? I put yes. I would consider this healthy just because they have that cash. So their cash is $2.4 billion, and their entire liabilities segment is $930 million. Then you could also look at capital lease obligations, and I guess you could add that to it. So, but still, they have more than double that in cash, so that's fine. Respectable management. This one I wanted to say yes because I like Alex Karp, I like Peter Thiel, but they haven't done a good job with so many aspects of the business. They're still not profitable. They are diluting shareholders. The stock price, every investor in the stock has lost money over the last 2.5+ years. There's multiple things that I don't like about what they're doing. So not the greatest, even though I do like Alex Karp. I think he is one of the more visionary CEOs we currently have out there right now. So I do like him, but they are making some mistakes. Number 14, the cash is more than income because they have over $2 billion in cash, negative income, no dividend, and the company is just over 20 years old, I believe. Let's see, it was founded in 2003, so it's just 20 years old now, which is another reason. If a company's 20 years old, you would think they'd be profitable by now, but they're not, and that's another red flag. So all in all, this stock gets a 10 out of 16, which is not considered a buy. Although, I mean, it's hard to say because the valuation's not super rich like it was. That was the problem before. The problem now is just they need to get some things straight financially, as far as cut back on the stock-based compensation so that investors can start making some money. Don't, what's the right way to put this? I guess they're irresponsibly raising money, financing cash to support this business, and that's the wrong way to do things. So they need to fix that, and that's pretty much it. So I don't know. We'll see what happens. I have faith in this business over the next 5 years. I think they will be able to continue growing at 20 to 30% a year, and I sure hope this stock gets back to the $20 range, but who knows how many years that could take. So that's all for today. Thank you for watching, and I will see you in the next video.